Hey everybody, it's Larry Berman here, off with an incredible week following yet another spectacular earnings announcement from NVIDIA. Clearly, the world has gone gaga over AI. Like we've said in the past, I think it's gonna get bubblish here. It could be a lot more upside from that perspective of how manias work historically. I commented last week we were short on the name. Obviously, was not a good week for that holding, without a doubt. We actually covered the short. Not that I'm bullish on the name here. I'm bullish in the context of years to come, but it does remind us a lot about what's going on now, a lot about the Nifty 50 and the idea of a market environment where so few things are working, given the breadth of the market is really lacking this year. And so when we think about what's causing that in terms of the economic climate, let's take a dive into the chart room and see what we learned this week. Again, looking at our major MSCI World indexes, we don't have the Friday pricing here because these are published with a 1 day lag, and there are no ETFs for an equal weight world index that I've seen yet. There's definitely MSCI World that gives you everything, and we'll have a peek inside that in a moment. But when you look as of Thursday's close and Friday, basically the S&P was flat and international markets played a little bit of catch up, but really flat on the day was the message. And we look at the NASDAQ, and then we look at the NASDAQ equal weight. Even within the NASDAQ, it's pretty clear what we're seeing, and that, it's the big handful of names that are really leading the charge where the average stock is not. Now, within the NASDAQ, there's only about 70% of it that's tech. There's Pepsi's in there and Costco's in there, and I think Walgreens Boots Alliance is in there. There's a handful of names in the Nasdaq 100 that is really not tech, not big tech when you think of what you're buying when you ultimately make the decision to buy the Qs. So that underlying strong economy, there's a lot of divergence, economically speaking, in terms of what's going on here. And it makes for a very difficult market environment. Our broad global equity fund this year is down slightly, because it's more of a value trade. It's more of an equal weight approach to the world. And of course, the world isn't doing much heavy lifting these days compared to the very few stocks that are. When we look at the MSCI World Index on a market cap weighted basis, something that is no surprise to anybody, Microsoft, Apple are on the leaderboard. But here's NVIDIA number three, sorry. But when you slide down just a little bit, you see Taiwan Semi and ASML. So AMSL is the sort of the creator of the tech that helps them fabricate and manufacture for Taiwan Semi. And Taiwan Semi, at the end of the day, produces a lot of what NVIDIA is putting together their IP around. So I think you kind of look at these three as the same, and they're now up all together right with the leaders in terms of their size and influence on the world markets. And then, of course, Amazon, Meta, Alphabet kind of make up the rest. I still think Tesla should be half of this, if not a third, before there's really any interest in owning it. So we remain short Tesla there. Berkshire is a weird and why it's there, because mostly it's just the market with a big position in Apple, much more of a value tilt, of course. But I think there's a big premium in Berkshire that's probably at this point, I don't know if it's overly deserved or not compared to the exposure it gives you. So this is a bit of a double count because it owns a lot of everything else you see here. Novo Nordisk, of course, moving up the board, being the Ozempic trade. ExxonMobil, for all the negatives about oil and gas, is still, one of the biggest companies in the world, um, and so forth. So again, looking at what is the average stock done in the world, the answer is not much. But let's see what's going on in the AI and technology space. So this again is the Global X Artificial Intelligence and Technology ETF. We've referenced it before here. And we mentioned last week about this little bit of resistance that's building up here against the old highs from 2021. And this negative divergence we're seeing here in the RSI relative to what price has done in the last couple months, or the first few months of this year. So, there's the NVIDIA earnings day. There's Friday, again, another gap up and a little bit of selling into it. Does this break out here or not? I don't think it will, but it very well could. And so how much more upside is left in this trend? You got to think it's pretty close to fully valued for now. Obviously, at this peak here, you would have looked at it and say, well, what are we paying ahead? And now 2 years ahead, it's at the same level. And so if you bought it here, now what would cause a massive correction here? And to me, it's the higher for longer message and the Fed not cutting interest rates and the massive amount of debt coming, just keeping things restrictive on the economic basis. And so when you look at what's now priced in compared to weeks ago, so you've had weeks now of the Fed pushing back, saying rate hikes not anytime soon. Cuts, I always say rate cuts not anytime soon, pushing back. So now by the end of the year, a little over 3 rate cuts. So it's very much what's priced in the market into the money market is very much in line with what the message of the Fed is. And that is pretty interesting. But what's not fully reflected on the long end of the curve when we look at TLT is this tremendous debt supply that's coming that increasingly is going to need to be financed with coupons because the liquidity in the repo market is coming down, and the Fed, the Treasury, can't keep tapping that resource to fund the debt. So more coupons are coming. We saw on Wednesday the 20-year auction was very poorly received, which is odd because that is the best yield on the long end of the curve. And for me, I like the off the run and the premium we get from off the run bonds, but hey, that's just me. So like we've seen with a lot of other bond supply, you get the backup of the market, higher yields, lower price into the supply, and then you get this little bounce or correction. So we had written to cover some bond shorts that we have in our bond fund. We had written 93 puts for expiry the 23rd today. And, as the last few days we were going to get put and cover our shorts, today we went up. So I rewrote puts to buy back my short at 91 for April. So I do think the long end is still going to see yields pushing higher over time. When that has an impact on the equity markets, that part has been hard to fathom because the AI craze is dominating so much that the whole macro side and flow of funds is getting choked off at the moment. But ultimately, fundamentals do matter. So the fundamentals are great, but we're paying an awful lot for them today. And so we should see a pause come into the AI sector against that resistance and some backing and filling. Again, dips are opportunities to buy. But if the bond supply story is very real, is not if it is very real, and that should weigh on asset markets in the coming months. So caution is the message. Again, I know I look silly telling you that. Be cautious with the indexes moving higher. But when I look under the hood, that's kind of what I see. It's not a time to be bullish on broader asset markets, given the breadth of the market is still lacking considerably. Hope you don't shoot the messenger. Have a great week, everyone.